Welcome to this explainer. Today, we're diving headfirst into a topic that has absolutely taken the digital and financial worlds by storm. We're talking about cryptocurrency. But look, we aren't just going to chat about buying it or trading it. We're going to explore the actual realities, the mechanics, and the sheer grit required to create your very own digital currency from scratch. It sounds like the ultimate dream for a lot of people, but as you'll see, the journey from a basic idea to a functioning coin is packed with intense technical and legal hurdles. To understand why everyone wants a piece of this pie, just think about this number, 43 million rupees or 43 lakhs. At certain peaks in the market, owning just a single Bitcoin could make you worth around 43 million rupees. That staggering valuation is exactly why the whole world is paying attention. In fact, if we look back to 2017, the Indian Bitcoin market alone was already valued at a massive $4 billion. When people see this kind of wealth generation, it naturally sparks a wild curiosity. If digital money can be worth this much, can anyone just hit a few keys and launch their own? Okay, let's dive into this. Here's our roadmap for today. First, the cryptocurrency craze. Second, coin versus token. Third, the blockchain foundation. Fourth, steps to launch. And finally, reality and risks in India.
All right, Section 1, the cryptocurrency craze. You know, for generations, we've been intimately familiar with traditional fiat money, rupees, dollars, euros. But in 2009, Bitcoin launched and completely flipped the paradigm. It introduced virtual money exchanged entirely over the internet, belonging to absolutely no specific country or central bank. Fast forward a bit, and like we mentioned, we saw the Indian market cap for Bitcoin hit that astonishing $4 billion mark in 2017. But Bitcoin isn't flying solo anymore. The media is constantly buzzing about alternatives like Ethereum and Binance Coin that offer super fast payments and major investment opportunities. This massive surge in investor interest is exactly what drives ambitious entrepreneurs to wonder how they can mint their own digital gold.
Which brings us to Section 2, coin versus token. Before we get into making anything, we really need to understand the fundamental building blocks, starting with the difference between a coin and a token. Think of it like this. Imagine you walk into an old-school arcade or a specialized pizza store. You hand over your real hard cash to buy their specific store tokens, so you can play games or buy a slice. Now, those tokens are incredibly useful inside that specific store, right? But the moment you step outside onto the street, you can't use them to buy groceries, and you definitely can't just easily convert them back into cash. In the crypto world, a token often acts exactly like this. It has a specific utility within a specific project or platform. A coin, on the other hand, is meant to function more like broader money, operating entirely on its own independent network. This brings up a really critical question for anyone looking to enter this space. Do you actually need your own cryptocurrency? Honestly, creating one just as a vanity project is a fast track to failure. The source material highlights that launching a digital currency is genuinely beneficial mostly for businesses that rely heavily on internet transactions, have a massive volume of digital payments, and actively need to grow an expansive, dedicated digital user base. Let's shift gears to Section 3, the blockchain foundation. So here's the deal. You literally cannot have a cryptocurrency without a blockchain. Think of a blockchain as a giant decentralized digital ledger. Unlike a traditional bank where one central server keeps all the records, a blockchain distributes those records across every single computer or node on the network. For a transaction to be valid, all these nodes have to agree. What does this mean? It means if a hacker wants to steal funds or alter records, they can't just hack one central server. They would literally have to hack every single system across the entire network simultaneously. No way. That is exactly why it's considered such a highly secure and reliable platform for digital currency. Because there's no single entity in control and security is the whole point, you can't just slap a cool name like XYZ coin onto a website and call it a day. Building on a blockchain or creating a brand new one requires deep coding and source code knowledge. Every digital currency functions based on incredibly complex software programming. Even if you're copying free open source code to build your coin, you still need to know exactly how to customize and secure it. It is deep, highly technical work. Let's see how this builds into an actual execution plan in Section 4, Steps to Launch. The process is rigorous, to say the least. First, you have to choose your infrastructure. If you want a brand new coin, you have to build a new blockchain. If you just want a token, you can use existing secure platforms like Ethereum. Next, you program the smart contracts. That's the actual code that dictates how the currency behaves. Then comes drafting the white paper, which is essentially your master plan. Following that, you set up your initial coin offering, or ICO, to raise funds and distribute the currency to early adopters. And finally, You absolutely must conduct a thorough security audit of your code.
Now, I cannot emphasize this point enough, and our source is incredibly clear on this. You cannot do this alone. The depth of the programming and the sheer complexity of the regulations mean that you must hire a professional technical expert team to maintain the security and coding, as well as a highly specialized legal advisor or attorney to make sure you aren't accidentally breaking any financial laws.
Let's zoom in on these requirements. You've got plenty of service providers to choose from, places like Waves, Blockstarter, CoinList, or Ethereum. But whichever you choose, your white paper is your ultimate pitch to the world. It has to detail your team members, your exact vision, and the underlying purpose of your project. When you launch your initial coin offering, you need to clearly define what you're offering to people in exchange for their real-world money. Plus, because the market is absolutely flooded with new coins, brand marketing is essential. Investors need to trust you, which is why that security audit we just mentioned is totally non-negotiable if you want to win over the community.
So you might be wondering, how long does the whole shebang actually take? Well, it's a massive spectrum. Technically speaking, you could generate a very minimal basic token on an existing network in about 5 minutes. But let's be real, a token minted in 5 minutes isn't going to attract millions of dollars. To do moderate development with proper documentation and a solid launch strategy, you're looking at a bare minimum of a month. And if you're building a robust, complex, audited blockchain and coin from the ground up, you need to prepare for up to 6 months of grueling, highly technical work. Which brings us to our final section, reality and risks in India. So the crucial takeaway here is perfectly captured by this quote from Nishal Shetty, the CEO of the crypto exchange WazirX. He points out that while the trend is definitely growing and buying Bitcoin is not illegal in India, the burden of investment responsibility is entirely individual. There is a very, very fine line between operating in an unregulated market and doing something illegal, and you have to tread that line carefully. What does entirely individual responsibility actually mean in practice? Well, it means this. There is zero central bank backing. None. The Reserve Bank of India, the central government, traditional banks, they take absolutely no responsibility for your cryptocurrency. If your digital wallet gets hacked or if an exchange goes bankrupt, there's no government safety net to refund your lost money. You are flying completely solo in the financial atmosphere. Let's look at a neutral breakdown of the pros and cons as outlined by our source. On the plus side, cryptocurrencies allow for incredibly fast, unlimited money transfers with super low fees and seamless international acceptance. It sounds great, right? However, the cons are incredibly steep. Because there's no central bank, transactions are completely irreversible. If you accidentally send money to the wrong address, poof, it's gone forever. Market acceptance is still pretty limited compared to traditional cash, and the market volatility is terrifyingly high. Prices can skyrocket or plummet in a matter of minutes. Because of these massive swings and the total lack of protections, if you still want to launch your own currency, you have some serious homework to do. You must do extensive personal research. You have to consult with experienced investment experts who know the risk factors intimately. Furthermore, because launching a coin costs real money and time, you need to secure dedicated investors on your side from day one. You have to calculate your risks meticulously before taking a single step forward. Creating your own digital currency is a fascinating technical feat and a bold financial venture, but it's clearly not for the faint of heart. So I leave you with this to think about. Knowing the grueling tech demands, the heavy financial and marketing costs, and the complete lack of a government safety net, are you truly ready to take the risk? Thank you for joining this explainer, and we'll see you next time.